All right, let me walk you through this the way I would explain it to another real estate investor sitting across the table from me, coffee in hand, talking shop. When I first started investing in real estate, I didn't think much about entity structure. Like a lot of people, I set up an LLC because that's what everyone tells you to do. It's simple, it gives you liability protection, and it feels like the grown-up move once you stop operating as a sole proprietor. For a while, that was more than enough. Deals were smaller, income was inconsistent, and my main focus was just surviving and stacking properties. But then growth happened. Rents went up, I added more doors, and suddenly my tax bill started to feel personal. I remember the first year I looked at my return and realized how much of my profit was getting eaten alive by self-employment tax. That was the moment I knew I had to stop thinking like a hobbyist and start thinking like a business owner who plays offense. The core issue is self-employment tax. If you're running your real estate operation through a single-member LLC or as a sole proprietor, the IRS treats you as self-employed. That means you're paying both sides of Social Security and Medicare. It's roughly 15.3%, and it's calculated on most of your net profit. No one is withholding this for you. There's no employer covering half. It's all on you, and it adds up fast. Let's say your rentals and flips generate a clean $100,000 in net profit. Before you even get to federal or state income tax, you're already staring down more than $14,000 in self-employment tax alone. That's real money. That's a down payment fund. That's a rehab budget. That's several months of mortgage payments. Watching that number year after year is what pushes a lot of investors to finally ask better questions. That's where the S corporation conversation starts. When you elect to have your LLC taxed as an S corp, or you set up an S corporation outright, the game changes. You're no longer just an owner. You're also an employee of your own company. At first, that sounds strange, but this is where the tax strategy lives. Instead of all of your profit being subject to self-employment tax, you pay yourself a W-2 salary. That salary goes through payroll like any normal job, and you pay payroll taxes on that portion only. The rest of the profit comes to you as a distribution. That distribution is still taxable income, but it is not subject to self-employment tax. That distinction is everything. Going back to that $100,000 example, imagine paying yourself a $30,000 salary. You run payroll, you pay the appropriate payroll taxes on that amount, and the remaining $70,000 comes to you as a distribution. Now instead of paying self-employment tax on almost the full $100,000, for a real estate investor, that kind of savings compounds. That's money you can roll directly into your next acquisition. It can fund reserves, upgrades, marketing, or just give you breathing room. Over a decade, it's not unusual for that decision alone to represent six figures in retained capital. Now, this isn't a free lunch, and this is where people get tripped up. The IRS requires that your salary be reasonable. You can T-pay yourself $10,000 a year while pulling in hundreds of thousands in profit, and expect that to hold up. Reasonable compensation depends on what you actually do in the business, your experience, your market, and the type of work you're performing. If you're actively managing properties, negotiating deals, overseeing rehabs, and handling financing, your salary needs to reflect that. There's no universal percentage written into the tax code, but in practice, many professionals stay in the neighborhood of 30% of net income as a salary to remain defensible. The key is being able to justify it if the IRS ever asks. You're not gaming the system. You're following the rules as they're written. You also need to understand the cost side of an S corporation. This structure comes with more administrative responsibility. You'll need payroll, separate business tax returns, and possibly higher accounting fees, depending on your state. There may be annual franchise taxes or compliance fees, all in. Many investors spend somewhere between $3,000 and $4,000 a year to maintain an S corp properly. That's why timing matters. In my experience, and echoed by many tax professionals, the S corp really starts to make sense once your net income consistently exceeds around $50,000 a year. Below that, the savings often don't outweigh the added cost and complexity. Above that threshold, especially if your income is stable or growing, the math starts working heavily in your favor. There's also a credibility factor that doesn't get talked about enough. Operating as an S corporation can make you appear more established to lenders, partners, and even private investors. It signals that you're running a real business, not just dabbling. In real estate, perception matters, especially when you're negotiating financing or joint ventures. Another important point is how income flows through an S corporation. It's still a pass-through entity. The corporation itself doesn't pay federal income tax. Profits pass through to you and show up on your personal return. The difference is how those profits are categorized. Salary is subject to payroll tax. Distributions are not. That structure is the lever that creates the savings as your portfolio grows. The benefits scale. More profit means more opportunity to optimize, but it also means the stakes are higher, mistakes get more expensive, and sloppy planning gets punished faster. That's why tax planning, not just tax filing, is critical at this stage. Filing tells you what you owe. Planning tells you how to legally owe less. I'll be clear about one thing. This is not a DIY decision. Every investor's situation is different. State laws vary. Your mix of passive and active income matters. Your long-term goals matter. This is a conversation to have with a qualified tax professional who understands real estate. Specifically, the right advisor doesn't just plug numbers into software. They help you structure your business to support growth. Looking back, switching to an S corporation was one of the most impactful decisions I made as an investor once. My income justified it, not because it was flashy or complicated, but because it aligned my tax structure with how my business actually operated. It allowed me to keep more of what I earned and redeploy it intelligently. At the end of the day, choosing the right entity isn't about paperwork. It's about control. It's about deciding whether your business works for you, or whether you're quietly overpaying year after year, because no one ever explained your options clearly. If you're building real wealth through real estate, this is a conversation worth having sooner rather than later. I wish I had understood it earlier. And if this helps you make a smarter move at the right time, then it's done its job.